It takes us to our talk of the tape, the state of this market and where it might be heading from here. Let's ask Liz Ann Sonders. She is Schwab's chief investment strategist. Welcome back. It's good to see you.
Hi, Scott. You too.
So we felt a little unsettled, I think, is fair to say, over the last couple of weeks. Yeah. Where do you think we're going from here?
You know, you had a distribution day yesterday, some weakening in breadth, but you're not yet seeing the kind of defensive leadership that you might see when you're getting toward the end of a consolidation period. It doesn't feel like, absent a catalyst, that this is going to unwind in spectacular fashion, but it feels like there's probably a bit more consolidation to go. What I wouldn't mind seeing is a continued profit taking, maybe up the cap spectrum into those prior high flyers, while you start to see improving breadth in other areas of the market. Not quite seeing that yet, but that would be one of the things I'm looking for to show a sign that maybe we're getting through this pullback, correction, consolidation period, whatever you want to call it.
Oh, so you think the NASDAQ, sounds to me like you're talking about the mega caps, you think they need to come in a little bit more?
Well, you know, when we started June, not only were they dominating performance, but only 15% of the S&P's constituents at that time were outperforming the overall index for the prior 60 days. And at least based on the data we have, that was a record low. And that was telling you that there was some risk of convergence. And we did start to see some improving breadth under the surface while you started to see a bit of a pullback in those names. I think probably a little bit more needs to be done there, and it would be healthy from the standpoint of sentiment that had gotten pretty frothy prior to this recent pullback period, and I think that needed to correct itself a bit.
Do you think we've entered into the good news is bad news zone again? Right? I mean, Atlanta GDP comes out right at 5.8%. We're like, wow, rates are already elevated. So you've got a two-pronged problem. You've got the prospect that rates would stay elevated if the economic news continues to be strong, and then, of course, what that means for the Fed.
Yeah, what's interesting is with the hotter than expected retail sales and IP today, you didn't really see the needle move in terms of probabilities for the September Fed meeting. That's still, last I looked at the CME tool, it was an 88% chance of no move in September, and that was reinforced by the Fed minutes that came out. I think where the disconnect still lies is the basis for what is still about 5 rate cuts coming in 2024. And that may happen, but probably not without some deterioration in the labor market or more broadly in the economy. The one thing I'd point out about GDP now is it's a nowcast. It's not a forecast. It just takes the data that has come in so far. And we're of course, only halfway through the quarter, which helps to explain why the blue chip consensus of economists for the third quarter is actually still sub 2%. So I've heard it billed as the nowcast billed as a forecast, and that's not what it is. It's a nowcast. It's the data that we have right now, what that says about growth.
Sure, but at least you extrapolate the fact that growth is still pretty good.
It is still pretty good, which again goes to the disconnect with what's the basis for 5 rate cuts next year. Yes, if disinflation continues and the Fed's in pause mode, that means real rates go up and become restrictive. But absent further cracks in the labor market or the economy, that may be what the Fed needs in order to really squash concerns about inflation volatility. So I think that still doesn't seem to square. Yes, we pushed rate cuts out of 2023 into 2024, but it still seems pretty aggressive. And to your original question around is good news, bad news, it may be, or not near-term Fed policy, but what it means for next year's expectations around rate cuts.
How many, forget cuts, I mean, how many hikes do you have in your mind as you sort of model out where you think the market's going to go?
I think they could be done. It's just a question of this sort of higher, the for longer part, I think probably has to get pushed out further into 2024. I think unless we get some really hot inflation number between now and the September meeting, I think the market's probably right in assuming the Fed is in pause mode right now. It's just a question of the span of time. And by the way, if you look back at history, there's been a wide range of spans between the final hike and the first cut, but they're fairly correlated to the unemployment rate. And historically, when the unemployment rate has been on the very low end of the spectrum, the time span between final hike and first cut is much wider, vice versa when the unemployment rate is high. So I think that has to come into the mix when we start to look at what the next step beyond a pause is for the Fed.